Simon, maybe staying with you here, can you just tell us the difference between, a strategic buyer versus a financial buyer, and, maybe the different things that those two types of buyers are looking for in a transaction?
Yes, a strategic buyer will come to a transaction with, they have their own business, they have their own vision for their business, and they believe that the target company that we're selling would make a great fit to accelerate their growth and development of their own business. And they believe that it will fit well within their business, that they'll be able to make certain cost-saving synergies, but also some upsell opportunity on the top line. But it's a case of 2 and 2 equals 5 in that scenario, and that they believe that they can take that business forward and do better. I think actually research says that certainly more than 50% don't equal 5, they equal 3 maybe. But there's obviously, that's up to them to properly integrate the business after and make sure they retain the culture and the upsides that business will give. A private equity investor will bring money to the transaction. They will bring resource as well that will be able to help in certain areas such as succession planning, but they're not fitting it with another business necessarily that they have in their portfolio, because that would effectively be a strategic transaction. But a financial buyer can still add value in the sense of giving them the governance and a methodology in terms of facing change within the business, such as succession planning, and bringing in a management team that's properly incentivized to take that business on to the next stage. It just won't be fitting with a strategic buyer and giving the overall global presence or other aspects to help grow it in that way.
Yeah, and there's historically there's been this idea that strategic buyers pay more than financial buyers. Bill, you want to comment on, again, strategic versus financial, maybe other buyers that you see at the marketplace? You talked about family offices already.
Sure.
And then this idea that, strategic buyers might pay more than a financial buyer. Is that the case?
Yeah, generally speaking, yeah, I think that would be a fair comment. Years ago, a friend of mine I made through business was a corporate development executive at Hoshiaki, which is a big Japanese refrigeration equipment company. And I saw him at a trade show, and I'm talking to my old friend, and he told me that they bought a company and they paid 12 times earnings. Okay, that's not as shocking today, but this was back, it's got to be about 05, 06. I mean, I'm in a world of thinking that type of business is trading for 5, maybe a 6 if people are crazy. I almost fell over. And I said 12 times, and he said it's the best deal that we have ever done, because we had a hole in our product offering. This company completely, perfectly fit this hole in the product offering. We are never going to sell this business, and it's the best fit for us. So if you can find that kind of a strategic where the owners of that company are looking to segue out, yeah, those strategics will pay a very, very sizable price. The private equity firms, maybe not so much, although they have trouble deploying capital. There's way too much money, not enough supply of good companies coming to the market, so they tend to bid those up. But that might be a good option too for a business owner who doesn't want to retire all the way, maybe wants to take some chips off the table and keep working for 3, 4, 5, 6 years and then retire, work with a partner who's going to build the business, maybe make another acquisition or two, and then sell it again. And then that business owner might be holding on to 20, 30, 40% of the equity from that original sale. And that might make a lot of sense where they can turbocharge that. So turbocharge their result. They can get more money over time than they can selling the business right now. And again, I've said this before, there's no right or wrong when you're thinking about it. The business owner has to make a decision. What are my goals? What do I want to accomplish? And then let's find the best partner to help me achieve those goals.
Yeah, that's great advice there.
John, there's probably a third category, which is the strategic buyer that's backed by a private equity firm. So it's kind of a hybrid. And when you're selling to those companies, sometimes you're dealing with the strategic and sometimes you're dealing with the private equity firm who acts like a corporate finance department.
Love those. I love those. strategic fit, and then they've got the dough to get the deal done. Those are great deals.
Right. So that didn't happen when I started the business. Now it seems like private equity is involved in so many of our strategics that we approach. So that's one that we like. When we sell to a pure strategic, our client is a private equity firm. Our client is what's called a platform company. That's the first company they're buying. Probably terrific management team that they'll grow. We closed the transaction a few years ago in the tree area, and since then they've made 12 acquisitions. And those 12 companies that sold to our platform company thought they were selling to a strategic, but yes, it's a strategic, but it's also backed by a very, very deep-pocketed private equity firm. And so that's I would say a third category that.
What disappoints me about that category, I think it is a good category, but if they've done the platform investment, they tend to have paid a big price for that platform. It sometimes sets the ceiling on what they're prepared to pay for your business. But the other big problem is that the private equity want to get the best return for their money. And if you have the best business that's going to be the best fit with their platform, they don't necessarily want to buy that, because if they can buy, a lookalike business that's maybe, a couple of notches below in terms of fit, but they can get it for much cheaper, I found over the years that they will tend to buy that business because they don't really mind what shape the business looks like when they come to exit. They just want to make sure that the 5 million, the 10 million that they invest on that acquisition is going to turn to 15 or 20 million at the time of the exit. And therefore, if they can buy something cheaper and make it, look like a complete business, then they'll do much better, which is a shame because I think there's some great business stories there, and we've missed some great sales side opportunities just because private equity weren't prepared to pay for the best looking business.
I mean, Simon raises a really deep, there's a lot of depth to what he just said. What he's really saying is if you're a seller and you recognize your weakness and don't mind talking about it and saying, listen, we've done this, we've got to this point, but we have no advertising, we have no sales force, we have a really bad IT area. Oddly enough, these types of buyers that Simon's describing loves that situation because now they're looking at your bottom line of 4 or 5 million going to 6 million very, very quickly with their secret sauce. So selling your weaknesses, we find, is just as powerful as selling your strengths.
Mm-hmm. On the flip side, with strategic private equity firms, I do find that they are, usually consolidators. They'll buy this platform company and then want to consolidate, whatever industry that they're in. And they're also good at doing transactions. They have the experience, they have the expertise of the private equity firm. So, on the flip side of maybe paying a little bit less, they are good acquirers just because they know how to get through a transaction, and they're mandated to kind of consolidate. So